Hello, and thank you for joining us for today's webinar. During this session, we will take a closer look at the paid leaves tax credits provision from the Families First Coronavirus Response Act. My name is Ann Barr, and I am one of the Payroll Operations Support Managers here at AHOLA. As the ever-expanding legislation due to the coronavirus crisis continues to unfold, AHOLA is here to help you stay up to date with the important changes that are affecting your business. We strive to keep you informed and provide easy access to many resources through our website and social media outlets, but we also recommend that you consult with a trusted business advisor, such as your attorney, CPA, or other qualified professionals when choosing the programs your business will participate in. Some of the programs and provisions cannot be used in conjunction, so it is important to review the options and decide which programs will best suit your business. As you are probably aware by now, the FFCRA, or Families First Coronavirus Response Act, requires employers to provide paid leave through two separate provisions. One, the Emergency Paid Sick Leave Act, and two, the Emergency Family Medical Leave Expansion Act. These provisions require certain employers to pay employees for time that they are unable to work due to very specific reasons related to COVID-19. When employers pay employees following the legal requirements of the Act, the FFCRA provides that employers are entitled to fully refundable tax credits to cover the cost of the FFCRA leave pay. The tax credits will reduce the employer's total federal 941 payroll taxes, which are federal withholding, employee and employer Social Security tax, and employee and employer Medicare tax. Today, we will discuss these tax credits and how they impact your payroll. Our session today will answer the following questions. What wages are eligible for the paid leave tax credits? How are the tax credits calculated, and how will I see these on my payroll reports? When should I expect to receive the funds from the credits? What happens if the tax credits on my payroll are greater than my tax liability? And what record should my business retain for these tax credits? Before we look at the details of the tax credits, let's see which COVID payments are eligible for the credits. The FFCRA outlines very specific reasons for when qualified leave pay is required under the Act. AHOLA has summarized these reasons and the related earnings codes on our FFCRA client acknowledgement form as shown here. If you have not yet received this form, please contact your dedicated processor. The AHOLA earnings codes COVID Sick EE, COVID Sick FAM, and COVID FMLA must only be used when paying employees who are unable to work for the reasons specified under the Act. The three codes listed on the acknowledgement form as A, B, and C are the only codes eligible for the paid leave tax credits. Again, these are COVID Sick EE, COVID Sick FAM, and COVID FMLA. Please note that any other non-FFCRA codes that you request under item D on the acknowledgement form, such as COVID Sick Other, are not eligible for the tax credits. Now comes the fun part. Just how are these tax credits calculated? Remember, the FFCRA qualified codes, COVID Sick EE, COVID Sick FAM, and COVID FMLA, are totally exempt from employer Social Security tax. Here you can see a payroll that had $2,400 in COVID Sick EE pay. You can see on the payroll summary that the employer Social Security taxable wages do not include the $2,400 of COVID sick EE pay. Therefore, the employer is not liable for paying any employer Social Security tax on the FFCRA pay. The tax credits that we're talking about today are in addition to this tax benefit. The FFCRA allows additional tax credits to be taken against the client's total federal 941 taxes, not just the FFCRA qualified pay. Here's the formula. The FFCRA qualified leave tax credits are the sum of the gross wages paid under the FFCRA qualified codes, plus the employer portion of Medicare tax on the FFCRA qualified wages, plus the qualified health plan expenses that are attributable to the wages paid under the FFCRA qualified codes. Please note that you must calculate and submit the qualified health expenses to AHOLA with your payroll. We will talk about what qualified health plan expenses are next. The FFCRA specifies that employers may receive tax credits for their costs of maintaining a group health plan for their employees while they are on qualified FFCRA paid leave, as long as those amounts are excluded from the gross income of employees. The amounts taken into account in determining the credits include the portion of the cost paid by the employer and the portion of the cost paid by the employee with pre-tax salary reduction contributions. In a nutshell, you must calculate the employer cost that is attributable to the FFCRA pay. A simple example is shown here. Suppose an employee is paid 32 hours of COVID sick EE pay for the week. You would calculate the weekly cost that you as an employer pay for health insurance for the employee. Then you have to calculate what the cost would be for 32 hours. In this example, the employer cost for 32 hours is $80. You would then submit $80 for this employee on your FFCRA earnings timesheet in column K. The FFCRA earnings timesheet was covered in a previous webinar. Please note that you must report the qualified health plan expenses separately for COVID sick pay and COVID FMLA pay. AHOLA has added 2 new memo calculation codes for this purpose. We suggest that you consult with your insurance broker or CPA for assistance in calculating the qualified health plan expenses. Now let's look at an example of how the tax credits will display in payroll. Suppose employee Mary Smith is under a local government order to quarantine due to COVID-19 and is unable to work. Mary is paid 40 hours of COVID sick EE on the current pay, and the employer's qualified health costs on this pay are $229. The tax credit will be $1,500 for the gross paid under COVID sick EE, plus $229 for the qualified health plan expenses on Mary's COVID sick pay, plus $21.75 for the employer portion of Medicare tax on Mary's COVID sick EE pay. Therefore, the total tax credit on Mary's pay is $1,750.75. Now let's take a look at where you will see the tax credits on your payroll reports and how quickly you will receive the benefits of the tax credits. For the example with Mary Smith, the total FFCRA tax credits were $1,750.75. Assuming that Mary is the only employee receiving COVID qualified pay on the current payroll, the credit of $1,750.75 will appear on the payroll summary report on a separate line item as shown here. Notice that it is shown as a negative number and therefore reduces the impound amount that the employer will remit to AHOLA. This means the employer is receiving an immediate credit on their current taxes. In Mary's example, the employer's federal 941 total tax amount was greater than the amount of the credit, and therefore the full credit was able to be taken right away. But what happens if the credit is more than the total 941 taxes? Suppose employee Steve is being paid 32 hours of COVID FMLA because he needs to take care of his 6-year-old son while his school is closed due to COVID-19. The tax credit on Steve's pay as shown here would be the COVID FMLA wages of $352 plus the qualified health expenses of $75 plus the employer portion of Medicare taxes of $5.10. Therefore, the total credit due is $432.10. However, the total federal 941 taxes on this entire payroll is only $42.02. You can find the total federal 941 tax amount on page 2 of the payroll summary report listed as total federal deposits, shown here at the top of the screen. Therefore, the maximum credit to be taken on this pay is $42.02. And you can see that the FFCRA credit taken here is $42.02 on the first page of the payroll summary report. The default in AHOLA's payroll system is that any excess tax credit will be carried over and applied to the next payroll within the same quarter. So in our example, the total credit on Steve's pay was $432.10, and the actual credit taken on the pay was $42.02. The excess credit of $390.08 will be carried over to the following payroll. The payroll summary here shows the next pay, which is dated April 30th. There were no COVID payments on this payroll. You can see that the carryover credit from the previous pay is being applied now. The FFCRA credit applied on this pay is $390.08. Here's what you need to know when you have FFCRA paid leave tax credits that cannot be fully taken on the pay date. The default is that the excess credits will carry over to the next pay date as long as it is in the same quarter. At the end of the quarter, if there are any remaining credits, they will show as a refund on Form 941 to be refunded to the employer by the IRS. If you are happy with this default procedure, you do not need to do anything. However, there is an option available under the FFCRA that allows employers to request advance payment of the excess credits from the IRS instead of waiting to apply them to future pays or waiting for a refund with Form 941. Employers may submit the new IRS Form 7200 to request an advance payment of excess tax credits. If you decide you would like this option, you must contact AHOLA in order to activate it for you. A couple of things to keep in mind about Form 7200 and choosing this option. First, you must contact AHOLA by sending an email to covidsupport@ahola.com as early as possible before you file Form 7200. It is extremely important that you coordinate this with us because our tax department will need to adjust your tax payments to reflect the amount you receive as an advance payment from Form 7200. If you do not coordinate this with us, then you may have an underpayment on Form 941 and owe the tax plus penalty and interest to the IRS. Second, please note that AHOLA cannot complete and file Form 7200 on your behalf. You or your CPA are responsible for completing and submitting Form 7200 to the Internal Revenue Service. If you have access to Isolde, you will be able to view your FFCRA paid leave tax credits under Client Management, Taxes, Business Credits. Also, Isolde will be adding a new report for the FFCRA tax credits very soon. We're down to the final question. What records should your business retain to support the tax credits? This slide gives you an idea of some of the documentation the IRS requires employers to retain to substantiate the tax credits. Records must include documentation to support the employee's leave, documentation to support the wages paid to the employee while on leave, documentation of how the qualified health plan expenses were calculated, copies of Forms 7200, and copies of Forms 941. Please refer to the IRS website for complete information. The best advice we can give you is to visit the IRS website at www.irs.gov. There is a plethora of information on the website regarding the FFCRA paid leave tax credits. It is also recommended that you consult with your CPA or financial advisor to make sure you are maintaining the necessary information. Records should be retained for at least 4 years after the Form 941 tax becomes due or is paid. Okay, are you feeling a little dizzy after all of this information? If so, you are certainly not alone. We covered a huge amount of extremely detailed information. But don't worry, AHOLA is here to help you through all of your COVID-19 payroll, tax, and HR issues. Don't forget to visit our website at www.ahola.com frequently for updates. Please be sure to consult the Internal Revenue Service website and the Department of Labor website for complete information about all of the COVID acts. In addition, if you have questions for us, please send an email to covidsupport@ahola.com. Someone from our COVID support team will be ready to assist you. And as always, you may contact your dedicated payroll processor with any questions. We appreciate you joining us today. AHOLA is committed to assisting you during the COVID-19 crisis. I would like to remind you that every Tuesday morning at 8 a.m., we are conducting short 10-minute informational webinars that address relevant topics related to COVID-19. We hope you can join us for these webinars. Again, thank you for attending today and stay well.